It's 12. Got it. It's 12 o'clock. So we got people with us and we're recording for those who are coming later. So I will introduce myself. I am Melanie from HomePro. We do home inspections, which are different than appraisals, which is why we are talking to mortgage people today. So I have, excuse me, the Jasmine mortgage team. I will let Jeff and Jasmine introduce themselves, and then we will take it away with a little bit of structure. If you have questions, put them in the Q&A and I will lead us in answering them as time allows. Jeff.
Hey everyone, I'm Jeff. I'm the husband of Jasmine of the Jasmine mortgage team. And I used to be a realtor. And that's how Jasmine and I met. But she's been doing mortgages for about 20 years. Jasmine, introduce yourself.
Hey, I'm Jasmine Krnjetin, and yes, I have been a mortgage banker for a minute. I started when I was 12, so let's not get too excited about our age here. And yeah, I've always been really good at recruiting real estate agents, and that's how I found my husband, by recruiting real estate agents. I reeled him in and brought him over to the dark side. So yeah, we're a direct lender, which means that we sell, underwrite, fund all of our own loans. We sell directly to Fannie Mae and Freddie Mac. And so closing loans with us is easier just because there is no in between. There is no lender between us and Fannie Mae and Freddie Mac. And so some of the things that we're going to talk about when it comes to inspections and appraisals and underwriters, just keep that in mind, that we don't have that one extra layer of review between us and Fannie Mae and Freddie Mac. And so some of the decisions that our underwriters can make are really, really critical to making or breaking deals when it comes to problems like inspection issues or appraisal issues.
Okay, so why don't we start there, Jasmine, and why don't you explain like a loan 101, like where you sell money, where does it come from, and why is it easier if you work with someone where it's all in one place?
Ooh, that's a good question.
Okay, you take it, Jeff. You do it.
So loan 101.
Yes.
Okay, so the important thing to realize, I think, as a real estate agent, loan 101, is that doing mortgages is kind of like having a retail shop, like you're selling shoes. You buy the shoes for $20, you sell them for $30. Okay. And if you can put 10 pairs of shoes on your shelf and in your warehouse, and you sell 100 pairs of shoes that month, you turned your inventory 10 times. And that's what lenders do as well. They have a warehouse full of money. It's actually called a warehouse line. They'll have millions of dollars on that line. And if they've had a $10 million line and they do $100 million worth of mortgages, they turned that line 10 times that month. So they're funding a loan, then taking the paper, selling it, getting their money back from Fannie Mae and loaning it out again. So that's why nobody would go into business with millions of dollars just for 3.875 return. You would want something like 15% return if you had millions of dollars. But that's how lenders always keep going, and you get these really low rates. So when people ask you, why do lenders always sell my loan? Well, they're really just moving the servicing. None of the terms change, but that liquidity in the market is what helps lenders stay liquid and be able to keep interest rates very low. So if your borrowers are like, or buyers, why did my loan get sold? It's so you can get the best rates on the planet. That's essentially what's going on. So it's good if we're all on the same page about trying to minimize that and make sure people know that's a good thing. Now, with appraisals, if anytime you're doing a loan, like if you're going to loan your car to somebody, you might say, leave me your Rolex and you can borrow my car. So now you've got some collateral, right? Now, when you do a mortgage, the collateral is the house. When I was a realtor, I thought the bank owned the house if you got a mortgage. That's not true. The bank has a lien on your house, but you own the house. The way that a lender proves the collateral is significant enough or worth enough to be collateral for a certain debt is through an appraisal.
Okay. Will you talk about the stages of a loan? Like you get approved and then what happens to it?
Go ahead, Jazz.
Yeah, so first thing that you do when you want to go out and buy a home is you have to talk to a lender and you have to get pre-approved. So that means that a lender is going to take a look at your income, your credit, your assets. We're going to make sure that you are pre-approved for XYZ amount of dollars. So then we issue a letter and we put you in touch with a real estate agent, and then that real estate agent starts showing you homes. Once you find a home and you have a contract on the home, now we actually do the underwriting process. Now we take that income, credit, and assets that we have already pre-screened, we put it into underwriting, and the underwriter goes through it, and then she issues a full approval on the loan.
And it's important to know that up until this time, the only thing that's been underwritten is the borrower, but the collateral for the debt, the house, has to be underwritten as well. And that's when the underwriter is going to really scrutinize that appraisal. All those comments the appraiser makes, they look at. All we usually do is look for the value. Did it come in at value, right?
Yes.
The other big thing is whether or not it's checked off underneath the value, as is or subject to. This house is worth $300,000 as is very different than this house is worth $300,000 subject to the tree that fell on it being taken off and everything repaired, right?
And that's what the appraiser does. They say as is or subject to.
Yeah,
Yes.
or subject to, it's worth this much as long as they take out the horribly stained carpets that aren't livable. Like, and that's a thing. If you got stains all over the carpets, the appraiser may say, until those are done, this is not a house that is ready to be lived in.
Okay, so underwriting is stage 2, and you can't do that. Is all of the underwriting of the borrower done in the pre-approval process? Like, is
A
there
good lender would do a lot of the borrower approving upfront, right? So like if somebody's self-employed, a good lender is going to take a look at that borrower's tax returns and not just assume because the borrower put $5,000 a month on their application that they actually make $5,000 on their tax returns per month, right? So a good lender is going to scrutinize their borrower before they put them in a car with the real estate agent, right? But an underwriter will go through everything with a fine tooth comb, and then she'll say, oh, it looks like that the last 2 months, the borrower has been receiving $3 less per hour than the year prior. What's the reason for this? We need a letter of explanation about that. So there is another underwrite that's a little bit more detailed. But again, if you have a team that's working for you that's been looking at loans for a really long time, we're going to catch all that stuff up front before we go to our underwriter for approval. And then, once you have the property picked out, like Jeff said, there is an appraisal, there is an inspection. We have to get the title work done. We have to make sure that the title to the home that you're buying is free and clear, that there is no mechanical liens, tax liens, IRS liens, any of that kind of stuff that can come up on title. So you have to buy a home that has free and clear title. And so all those things get put together and then put in front of an underwriter who then clears the loan, right? Once everything is done, everything looks perfect. That's when you get what we call in the business, we call our clear to close, which means now you're ready to close because the collateral is clear, the title is clear, and the value is good, and you as a borrower are fully approved.
And so how long does that process usually take, the underwriting process?
Well, it varies. The industry standard is about, from start to finish, about 30 days. Basically,
of underwriting or the whole
process after you go under contract. And a good lender will be able to respond to when you submit a file. They'll be able to respond within 48, 72 hours that you get your underwriting decision. And that decision typically is not clear to close right out of the gate. It's typically, we needed a letter of explanation about this. I need to know more about how they're going to make money after they've moved to this city from another city. All those kind of questions will come up. Those are called conditions. So your loan is conditionally approved. It's kind of like a subject to appraisal. Your loan's conditionally approved, assuming you can get me this letter of explanation and you can prove that you can still make money when you move to Atlanta. Once you supply those things and the underwriter likes it, then you have your clear to close.
Okay. And when you're clear to close, does that usually happen like the day before closing, or does that happen a couple
It can
weeks before
happen up to or on the day of closing, you could get a clear to close. It depends on how the underwriter, how the lender operates. It's much more comfortable for everyone if we have our clear to close several days ahead. Now, one of the things we've been working on in this competitive buyer's market, well, seller's market, but it's competitive for buyers, is that as we've been doing a 15-day close and just offering that because we know how critical it is to move fast against cash offers. So in a 15-day close, we can't miss a single beat. There's no waiting for the home inspection to order the appraisal. So for your buyers, what that means is they're not going to spend $100 on the inspection and get to think about whether they want to spend hundreds of dollars on the appraisal. They're dropping both checks day one. And if they don't want to move forward or something falls apart, they're out that money. But that's some of the stuff that you have to deal with in this market. Mm-hmm. And in a 15-day close, we're not going to have a clear to close long before closing. It's going to be closer because everything's crunched.
Mm-hmm. Okay. That's really helpful. When do you get your rate? When would I know my rate in this process?
Go ahead, Jazz.
So interest rates typically get locked in once you are under contract, because the interest rate is tied to your social security number and the property address. That's what kind of ties down the interest rate. So we typically lock in the interest rate the day that you go under contract. We have some options right now where, because the market is funky, we have some locks that we're able to offer with a TBD address, meaning even if you don't have an address, we could do a 60-day lock, assuming that you're going to find something and get under contract over the next 60 days. So some borrowers that are uneasy with the current rising interest rate environment, they're choosing to do the TBD rate locks. And that's helpful. That can soothe some clients that are worried, are my rates going to be at mid fours or high fours before I find a home? Because especially if they're sensitive to the monthly payment, it's a good option. But yeah, that's typically when you lock in is once you're under contract most of the time.
Okay. Next question I want to ask, let's move into the inspection and appraisal part of underwriting. So I have one more question. So you pay, I assume there's an application fee that's paid in the pre-approval part, or no?
No, there are costs that lenders incur, that we probably spend $50 to $100 on different things for a pre-approval. Okay. So some lenders, and that's significant if you're going through a lot of them and you're not closing a lot of them. So you'll see some lenders have an application fee to cover some of those costs, whether you move forward or not. We do not. And that's lender to lender. I think it's more typical that there's no cost to get pre-approved though.
Okay.
And we had a message from Chelsea about what is the extra cost to a buyer to do that rate lock. And I'm pretty sure she's talking about the TBD address.
Oh, yeah.
So nothing's free. So what is the cost there, Jasmine?
You're locking in at a slightly higher interest rate than the current market. So if the current interest rate right now for a 30-day lock is 4%, if we did a TBD lock, we would lock you an eighth higher. So we would lock you at 4.125. So you're paying slightly more for the security of being able to have a lock saved for the next 60 days, but it is a longer rate lock versus just like your typical 30-day lock that you would take out.
Interesting. And I love the way that you talked about that you pay a little more for more security, because that's really what the home inspection process is in terms of a buyer. You're paying for information so that you can mitigate some risk of what this house is. So let's talk about, this is when the buyer probably starts in on their incurring their expenses. Talk to us about appraisals and who orders them and how they vary based on the kind of loan it is.
Absolutely. So the lender has to order the appraisal. It's not very common, but sometimes we have people that want to order their own appraisal, but they can do that. It's just the lender can't use an appraisal that's ordered by someone else. The lender has to find an impartial, references checked, whether they're on the naughty list for certain banks, and that there is a naughty list for appraisers. For example, Chase might be like, I can't believe this appraiser did X, Y, Z. We never want to see that appraiser on another loan that we're going to buy. And so there are lots of checks and balances, but the lender has to go find an independent third party to give an opinion of value.
Mhm.
And that happens once we're under contract. Now, sometimes typically if the borrower has a great credit score, there are a lot of other comps in the area that are electronically identifiable by computer systems, and there's a big chunk of money down, and you can read that as lower risk to the overall loan. The more skin in the game, the less likely someone is to stop paying the loan. And all of those things can equate to us getting what's called a property inspection waiver. And that is known on the street as an appraisal waiver. But you'll notice I said the word inspection. In the industry, when the appraiser goes out, it's referred to as an inspection, which is very different from a home inspection where somebody's crawling around in the crawl space.
Okay, that's perfect. What's next? So tell me what the difference is. Why is it called an inspection?
Well, the appraiser goes through the home. She does not carry one of those little plugs to tell you if they're flip-flopped or ground faulted or something like that. But if one of the outlets has big smoke stains, it looks like something you'd never want to plug anything into because it obviously had just caught on fire, the appraiser is going to say something about that, right? There's going to be a comment, hazardous electrical situation, and an underwriter is going to be like, get me the electrical engineer. I don't know who they would call for. We need a letter from somebody that's legitimately able to write a letter about this to state if this house is safe. And it assuming everything's been fixed and it's safe, now it needs to get painted so it doesn't look crazy. So that would be a typical kind of response to something like that. The appraiser is going to look around the exterior of the home. If there's unpainted siding or windowsills or anything like that, that's a big no-no. Anything that's not 100% complete will be subject to. So if the bathroom is in, but obviously there's going to be a nice glass shower door, and the appraiser walks in and that shower door is not there, then it will be, this home is worth this much subject to the shower door being put in. And so what has to happen then is the shower door is put in. We have to pay the appraiser another $100 to go out and look, say, yep, it's in, the home's 100% complete, and now it's an as-is appraisal.
Yeah. And I think, since we're talking about things that get flagged on appraisals, I'm going to keep coming back to this for consumers, and especially like real estate agents that are talking to their buyers, having your team together and knowing how to deal with problems is really how you make or break deals. Because we had an appraisal that came back with a comment from the appraiser saying, there may or may not be a sinkhole in front of this home, right?
May or may not. Great.
Yeah.
And so if you have a very tunnel vision underwriting team working for your lender, they're gonna look at the appraisal, they're gonna see sinkhole equals loan denied, move next. Right, no questions about it, right? It's just going to be like, there may be a sinkhole, we just need to move on, versus if you have a team that understands how appraisals work and no, it's probably not a freaking sinkhole. There was just a tree that was removed and there was a hole that was dug up, right? So if your team knows how to play and how to get the right inspector out there to verify, no, it's not a sinkhole, and give that back to your underwriter, and your underwriter review it and say, yeah, you're right, it's not a sinkhole, go ahead and move forward. That's how a deal that could have just gotten completely sidetracked just by that one sentence by an appraiser. So it's really important that you have people that know the business working for you. Even if you're a newer real estate agent, definitely hook up with a mortgage banker that really knows their stuff, because they're going to save you over and over and over again from these kinds of problems. Because when you've been doing this for a couple decades, there's pretty much no problem, or I should say no issue you haven't come across We've pretty much seen it all.
Also why we get on the personal home inspection. So the home inspection, if I'm a consumer and I order a home inspection, does that ever, does the mortgage people ever see it? Does underwriting ever see it?
Yes. Do you know why?
Why?
Because someone screwed up and sent the inspection to the lender.
I've never seen an inspection delete. The moment
Okay.
it's
Well,
my
that
inbox,
must
it's
be-
auto
prank call,
deleted.
prank caller. Hang on.
So how does it get to the lender?
By
What would that
accident.
screw up look like?
By accident. Usually a borrower with the right intentions is just trying to make sure the lender has everything.
Okay.
Or there is a situation where the underwriter says, there appears to be an issue with ABC on the appraisal, and then your not very experienced mortgage lender asks the not experienced real estate agent for the home inspection, and next thing you know, that underwriter's got a hold of that home inspection. Now the underwriter is like, well, there's 8,000 other things on this home that have to be fixed.
And the other one is a little
Different.
more technical, Mel, and that's
Mhm.
when someone writes in a special stipulation,
Yeah.
per XYZ in the home inspection, we need dit. And then the underwriter could very likely say, well, the contract references this document, I need to see it.
Okay. So if I'm a real estate agent, even if I want them to fix something, I don't reference home inspection.
That's very good advice.
Good advice.
Mhm.
And one more thing. So that also explains, we sometimes will have the clients that we work for, something comes up in the appraisal, and it seems like the appraiser is just like, they kind of note that it might or might not exist. And they'll ask us for a letter, which we're able to do a letter on our letterhead about what we observed during the inspection for the mortgage without having to reference the entire inspection.
Yes,
That's
like a better way
pretty
to-
good way to do it. And
that's next level.
it's that's really good, because on that sinkhole example Jasmine was giving, that was a real example. It's important that your lending team has an underwriting staff that can get back to them with questions quickly and not take 4 days just to get an answer, because that sinkhole was an issue. And I didn't know, do I have to get a civil engineer out there, or can I just get a landscaper to go look at it and tell us what it is and send an email? Turned out an email was fine. And a landscaper sending us an email after actually going out and looking at it. Okay, third party that knows the area and obviously knows yards,
Right.
says this is not an unsafe situation. This looks like where a tree was removed.
Yeah.
Okay. Somebody wants to know how often people qualify for the appraisal waiver.
I would say, what percentage of loans do you think we get the appraisal waiver on, Jazz?
Yeah, it's generally if you're putting 20% down.
Okay, so that's something you
that-
can know ahead of time.
Yeah, so typically what happens is if I have a borrower that's putting 20% down, it's property specific. It's not that borrower is going to have every appraisal waived. It's 123 Main Street coupled with this borrower putting 20% down that gets you the appraisal waiver. So when we're going into a competitive situation, my real estate agents, especially if they're trying to waive the appraisal inspection or the contingency, they will tell me, hey, we're making an offer on 123 Main Street. Can you check if we can get a waiver? And so I'll run it through Fannie Mae's system, and then Fannie Mae or Freddie Mac will say, yes, you've got a property waiver on this one. And so then they go back and now they know we're not going to need an appraisal, so they can write an offer without an appraisal contingency.
Okay, so they need to, if they have access, if the real estate agent has access to a personal relationship with the lender, you can check that ahead of time of writing.
And that does cost money every time we run that. It's another 50 or 75 bucks. So it can't be like, here are 20 homes we're looking at, which ones, that's thousands of dollars all of a sudden, right? And do we have to send out disclosures if we do that?
No.
Okay, good. And there is a small chance, and Jasmine, how often does this happen, that we run it through, we get a property inspection waiver, we go under contract, and then something has changed in the file. Maybe the income calc is different or something, or the credit score went down since we did the pre-approval, and then we have to get an appraisal.
Yeah, I think I've had that happen once. It was on a refinance where we started out with it was a refinance where we started out with an inspection waiver, and then the income came in significantly lower. And now our the file was not as strong. And now the automated system came back and said, actually, you need an appraisal waiver. And you need an appraisal, I apologize. So you can, it's even like in the fine print that Fannie Mae gives you, it's like, there is a chance that we can revoke this thing. I haven't seen it happen on a purchase. It was on a refi, but I think if the client profile, like Jeff said, like if the credit score suddenly drops from an 800 to a 600 credit score, or if you were expecting to have $5,000 in income and now all of a sudden you only have $3,000 in income or something like that, then that could trigger, the appraisal waiver being taken away. But knock on wood, haven't seen that happen on a purchase. You got to know your stuff up front.
I think that's the theme of today.
Yes.
I have a couple more questions that have been sent in. What is the difference in importance between an FHA, VA home appraisal and a separate private home inspection?
So the difference between FHA, VA appraisal
and a private home inspection in terms of the mortgage, what's the difference?
Well, I mean, obviously any home inspection that Home Probe does is going to be very extensive, looking at all the technical aspects of the house and a lot of detail and getting in areas where there might be snakes or rat droppings or all that stuff the inspectors do. The appraiser, and anytime there's a home inspector that finds rodent droppings, you should always ask if they're fresh. They love it when you ask if they're fresh droppings. So that's just my favorite thing to do. So the difference is really the level of detail. But since the question was about FHA and VA, I'm kind of thinking that it was kind of along the lines of what's different about appraisals for FHA and VA versus not FHA and VA.
Why don't you talk about that?
Okay, so FHA is extremely, extremely protective of buyers. So regardless of your appraisal contingency, if you will, and you'll notice the financing contingency is different for FHA. There's an FHA amendatory clause. There's an FHA amendatory clause that says if this property, anytime prior to closing, like even the day of closing, anytime prior to closing, if an appraisal comes in below the sales price, the buyer can walk away and suffer absolutely no penalty, including forfeiture of earnest money. Now, you might say, well, how would that happen? I got an appraisal on day 7 and we're fine. Well, banking and lending is highly regulated. There are a certain number of files that have to be scrubbed right before closing to meet compliance standards. And if an underwriter goes in and says, this home's in the city of Decatur and all the comps are unincorporated DeKalb, like it would probably be flip-flopped. But yeah, you get my point. They could say to the appraiser, I need comps that are city of Decatur, and all of a sudden the value changes. Now, probably in that situation, it would have gone up if it went from unincorporated to city of, but you get my point. And so on the day of closing, worst case scenario could be that another underwriter looks and asks the appraiser to send a couple more comps, and then it changes the value and the deal is different. And that's a protection for buyers that FHA offers. It's also why it's hard to win a bidding war with an FHA buyer, because they can't remove that. You can't special stip that away. That's federal stuff. And it's a serious thing. Now, there are also parts in there where it's saying, if there are requirements to be made to the improvements to be made to the home so that it can go FHA. For example, one of those is if there's public sewer and water available, the house must be connected to them, right? If such things are found, and you'll see this in some of in the GAR forms, if such things are found, how much is the seller on the hook to pay for to improve them? Most realtors will put very small numbers in there so the seller doesn't get scared. But at the same time, as a seller, you need to know if it's going to take $5 grand to connect to city water and sewer, and I've only committed to pay $100, the deal can fall apart over that.
Because the buyer will be required to do it by the loan.
The property, no, the property wouldn't fly for FHA.
Oh, okay. It'll just,
now,
they won't
the
be able to
buyer
get it.
could do that, but most FHA buyers do not have an extra few $1,000s sitting around.
Okay. So that's where when people talk about whether a house passes or fails inspection, it always confuses me, because in my world of home inspection, the consumer gets to decide if the property passed or failed. But it sounds like when we're talking about appraisal property inspections, there are passing and failing for FHA and VA. Is that right?
I don't know if that's, I don't really hear people use pass and fail
Okay.
as the terms, but you know, there could be some issues that are specific to FHA or VA. For example, handrails on all the stairs.
Okay.
You know, my mom's 76 years old and she doesn't have a handrail on one of her stairs, but if we were going to sell it to an FHA buyer, I know I would have to put one in.
Okay. Do you know, is there like a list of minimum home requirements that FHA or VA uses?
I Googled that this morning. And I think I asked my whole team, we just kind of pick up over time. Ultimately, it's going to come down to the underwriter. First off, it's whatever the appraiser writes. If the appraiser doesn't see the water in the crawl space and doesn't mention it, but there is water in the crawl space, the lender's never going to care. The underwriter's not going to know about it, right? But if they do see it, anything that affects the safety, livability, resale of the home is going to be mentioned on the appraisal. So, and the reason that you can't get a traditional mortgage without it being a renovation or some kind of construction loan on a house that's in disrepair is that if the borrower moves in and those leaks in the roof continue and the collateral for the debt is then depreciating rapidly, all of a sudden you're in a bad situation. If they lose their job, they can't sell the house because they're underwater now because that issue just kept getting worse. So if you walk into a home and there are stains on the ceiling and the seller says that was a roof leak, it's been fixed. Well, the appraiser is going to say there are stains on the ceiling. I don't know if this leak is active or not. So it would be a good idea to paint the ceiling before that appraiser walks in there.
Okay. Or that's one of the things we can tell, like with our moisture meter, and like we can provide further evidence.
Yeah, so you could feel real comfortable about that. And then when the appraiser goes out there, you're like, well, I'm comfortable with it, but now we got to change something or document something. So I think that's an important one as well. A lot of exterior stuff, any crazy like cracking and settling, like if a front porch is skewed or something, that kind of stuff, an appraiser is going to mention. It has to be real obvious to the naked eye for the appraiser to mention. Does it have a stove? Is there heat in every room? You know, all of that kind of stuff is going to get taken into account by the appraiser.
Okay, interesting. Do appraisals vary by state?
It's pretty uniform. There may be some things that vary, like I'm just thinking off the top of my head, maybe like you know how all the products you buy, they say meets California regulation XYZ, right? Well, there's probably something like that as well. But generally, it's a uniform residential, appraisal form that's generated, and it's going to be the same all over. But some of the specific state or municipality kind of requirements might change. Okay.
Do you have going back to mortgages in general and away from the appraisal and the inspection part, what is the general, like when we keep hearing rates are going up, what is that? And that means buyers, like their payment is going to go up, right? But do you have a guideline for how much rates go up? How much does that affect my payment?
Yeah, I just did a calculation like that last week, and you can kind of do the same thing on your own, but I was kind of like, well, if rates go up 1% over the next year, and we just experienced a nationwide 20% average on appreciation. Now, that's not sustainable, but let's say this year it was 10%. Okay. So rates go up by 1%, values go up by 10%. The change to the monthly payment for the borrower just went up by 30%. So the cost of waiting is that significant. And you want to run those numbers. Just go into, if you download Jasmine's mortgage app, it has a bunch of calculators. You really don't have to do a whole lot. I mean, the taxes will shift, right? If your property is worth 10% more and the taxes stay the same, you're going to end up paying 10% more in taxes if the millage rate and everything stays the same. But the big driver of the payment is the interest portion, the principal and interest portion of that payment, and that can shift dramatically. I think it's good to be able to have those numbers just to rattle off to folks.
Okay. And where if people want to go do their own calculation, you mentioned Jasmine's calculator.
Yeah, we would.
Where can we find it?
I wish I had an easy way for you to get to it. I have to send you a link to it, but we're happy to do that. And those calculators are really good because Jasmine's calculator includes mortgage insurance in the payment, which is really helpful. So based on your presumed credit score, based on the down payment, based on all of that, if there's mortgage insurance, that could be several $100s a month. And most online calculators don't do that. They just say, how much is the principal and interest? They don't even tell you what the taxes and insurance are. But yeah, so it's important to plug all of those things in and take a look at it. But we can send that out. I'm sorry, I don't have a link. No,
that's okay. So people can contact the Jasmine mortgage team, and you don't have to be under contract. You don't have to be in pre-approval. You can help people sort it out.
And I love talking to realtors. That's my passion, is helping realtors grow their business.
One more question. HOA, is that part of for condos and townhomes? We're seeing a ton of condos and townhomes in our inspection.
Yeah, as prices go up, the affordability of those increases. I'm not sure why my camera just turned off.
That's okay, but can Jasmine give information about that as well, if there's an HOA factor?
So really the HOA piece, the HOA has to be underwritten as well. It's simpler with a townhouse, but keep in mind that if you look, I'm looking across the street right now and I see a detached single family home. It was almost certainly deeded as a detached single family home. It could have been deeded as a condo. So what it looks like has no bearing on whether or not it's a condo. There can be freestanding condos. There's one on Coventry Road in Decatur. It's a little granite house that is owned by the HOA. The HOA owns the exterior and everything of that thing. And whoever owns the inside is the owner of that home, but it's a condo. If the roof leaks, they don't fix it. So on a townhouse, it can look like a townhouse, but be a condo. Or if they say it's a fee simple townhouse, that needs to be verified. If the roof leaks on a fee simple townhouse, the homeowner has to fix it. So the townhouses might look like a townhouse, but be a condo. And if it's a condo, it changes the risk factors of the loan. And you're basically getting a loan with you as the borrower and the HOA, both very much involved in the security of this transaction. If the HOA doesn't have any money in reserves, that's not good. That would be like you not having a full-time job. I mean, that can kill a deal just as much as the borrower not having, the financial ability to get approved. So the HOA is underwritten also when you're buying a condo. Less so when you're buying a townhouse, especially a fee simple townhouse, but there is still some kind of some due diligence that's done on all HOAs that are involved.
Awesome. Well, I feel like we could have our own class just on HOAs and how they affect the mortgage.
That's a whole another story, right?
Here's a little tidbit that I think could, oh, I'm sorry, go ahead.
No, go ahead.
The tidbit on HOA, and this is just good rule of thumb for any realtor to know. $500 a month in payment equals about $100,000 of purchasing power. Okay.
Oh, wow.
So that's just a rule of thumb. Okay.
So if I'm approved for 400,000, then I have to account, I'm really only approved for 300,000 if there's a $500 HOA monthly fee. Okay.
Yep. And so if it's 250, then you're approved you could buy a 350 condo with a 250 HOA in general. I mean, that just gets you close, right? It helps you when you're out there with your client decide whether you're going to drive 40 minutes to go see this next thing. Then the lender can take a harder look if you think it's going to work.
Awesome. Awesome. I do think we are going to do a whole separate class on HOA. I
Mhm.
think that I opened Pandora's box and we're honest about it. I
You
want
sure
to take
did.
more time than I promised. Y'all are such a good resource in the mortgage world. Thank you so much. I learned a ton and I feel like I do this all the time. And so I'm excited for this to get in the hands of realtors and they can share this information with their buyers and help them be even more competitive in today's crazy, crazy market. Thanks, Jeff and Jasmine. I will see y'all soon.
Thank you,
Sounds
Mel. We
wonderful.
love Home Probe.
Bye.
Thank you.
See ya.
Bye-bye.